Well, as the stock market continues to forge ahead and hit a series of new highs, one important aspect of stocks' return is frequently overlooked. That is the income portion, or the dividend. Historically, returns from dividends make up approximately 1/2 of a stock's annual total return in any given year. And with bond yields so low right now, many individual investors are increasingly looking to stocks for investment income. In this morning's U.S. Bank Economic 360, U.S. Bank senior equity strategist Jim Russell joins us with his perspective. Jim, good to have you with us.
Brian, good morning.
These stock dividends are really important to us as individual investors. What do they mean for you and me?
Well, they mean a lot. A dividend is just great stuff. Stocks bob up and down, and of course they bob more up than down this year. We're up about 20% plus on the S&P 500 this year. However, in years where stocks maybe bob down, trade sideways, a stock dividend can provide the investor with a certain return. Now, what we've got here is an example of good old Procter & Gamble, maybe a stock that folks that are viewing or joining us today have maybe heard of. What you can see here is if you had bought Procter & Gamble on the first day of the year, you would have received an annual dividend of $2.21 per share. You can see what the stock price was at that time, 67, a yield of 3.26%. Fast forward to more recently, that dividend has been increased 5.7%, which is a key benefit to dividends. They do normally increase, and they beat the pants off of inflation. Procter's had good luck this year. The stock price has also increased 20%. You can see the yield has fallen just a little bit, but in terms of a total return, we're talking about something in the order of 22-23%. So dividends provide that solid income, and again, it compares very favorably. Those kind of yields compare very favorably against the bond market, as you'd mentioned, which yields about 2.6% right now.
So, Jim, in general, are companies paying more or less in dividends to their investors?
Thank goodness companies are paying a little bit more. Now, we had a little bit of a timeout during the financial crisis where dividends at some companies were cut, and you can see that in the graphic there. Right now, dividend payments to investors are at an all-time high at $307 billion for 2013. That's an increase of 7% versus last year, which would be kind of representative. A 7% increase is about what an investor could expect in terms of annual increases from their dividend for most companies. Now, 415 companies out of the S&P 500, or 83%, pay dividends. Again, most increase their dividends on an annual basis.
As we look ahead to 2014 and beyond, what do you see in the way of dividends and their return?
The news is really very good there, Brian. And what we see there is that most companies are in a very good position to increase their dividends. Now, going all the way back to 1936, companies, for every dollar that they earn, typically pay about half out, 49.2% in dividends. Now, we're well below that right now at 33.7%, indicating that companies are very profitable right now, are in a position to increase their dividends dramatically. We think not just for 2014, but really for the next, call it 5 to 10 years on an annual basis. So again, we think this is a very, very important thing for investors to keep in mind.
Thank you. Very interesting way to look ahead. We appreciate you, Jim, and U.S. Bank.
Great to be with you.